A formula from 1968 predicted corporate bankruptcies with up to 95% accuracy. Edward Altman combined 5 accounting ratios into a single score. Companies above 2.99 are safe. Companies below 1.81 are in distress. The question, does avoiding distressed companies actually improve your stock returns? We built the screen, tested it with real data, and the answer is more nuanced than you'd expect. Edward Altman published the Z-score at NYU in 1968. He studied 66 companies, half bankrupt and half surviving, and used discriminant analysis to find which financial ratios best separated the two groups. 5 components, each doing a specific job. Working capital over total assets gets a 1.2 times weight. This measures short-term liquidity. Companies that can't cover near-term obligations fail first. If current assets don't exceed current liabilities, this term goes negative and drags the whole score down. Think of it as the first line of defense. A company with negative working capital is already borrowing to keep the lights on. Retained earnings over total assets gets 1.4 times. This captures cumulative profitability over the company's entire life. Young companies haven't had time to build this cushion. Companies that consistently lose money burn it away. The formula naturally favors mature, profitable businesses. A firm that's been profitable for 20 years has a deep pool of retained earnings. A startup burning cash has almost none, and the Z-score reflects that gap directly. EBITDA over total assets gets the highest weight at 3.3 times. Operating earnings before interest, taxes, depreciation, and amortization, scaled by total assets. This is the core earning power test. A company generating strong cash earnings relative to its asset base can service debt, fund operations, and absorb shocks. Altman gave this the biggest multiplier because current earning power turned out to be the single strongest predictor of survival in his original sample. One note: Altman's original formula uses operating income. Here, we use EBITDA, a close and more consistently reported proxy. Market cap over total liabilities gets 0.6 times. The market's assessment of equity value relative to total obligations. If investors value your equity at less than your total debt, that's a warning. This is the only component that uses market data instead of pure accounting numbers. It lets the market weigh in on whether the balance sheet tells the full story. Revenue over total assets gets 1.0 times. Asset turnover. How much sales the company squeezes out of each dollar in assets. Capital-intensive businesses with slow turns score lower. This ratio varies wildly by industry, which is one reason the Z-score can be misleading when you compare a software company to a steel manufacturer. 3 zones come from the output. Above 2.99 is safe, less than 5% bankruptcy probability. Between 1.81 and 2.99 is the gray zone, uncertain territory. Below 1.81 is distress, where Altman's original study correctly identified 95% of bankruptcies 1 year ahead. Follow-up studies over 3 decades confirmed 80–90% accuracy across different samples. Ilya Dishev published a study in 1998 testing whether distress risk gets compensated in the stock market. Classic finance theory says it should. Higher risk, higher returns. That's the deal. Dishev found the opposite. High bankruptcy risk stocks earned lower returns, not higher. The distress premium that theory predicted didn't exist. 3 forces work against distressed companies. First, survivorship bias in the theory. The risk premium assumes you hold through distress and recovery, but distressed companies often go to zero. No recovery to hold for. Second, equity dilution. Distressed companies raise capital by issuing shares. Your ownership stake shrinks. The company survives, but you own less of it. Third, behavioral overconfidence. Investors chase turnaround stories. A stock down 80% only needs to double. That reasoning ignores the base rate. Most distressed stocks stay distressed or disappear. The investment implications sound straightforward. Filter out distressed companies and your portfolio should improve. But whether that actually plays out depends on the market. We'll get to that. Let's build the query. The platform has a pre-calculated field in the scores table, so we don't need to compute the 5 components manually. Altman Z-score greater than 3 filters for the safe zone. Market cap above $1 billion removes microcaps where the Z-score calculation can be unreliable. We exclude financials and utilities directly because banks run high leverage by design and utilities carry regulated debt, so the formula misreads both. Then we sort by market cap to surface the largest safe zone companies. Run this and the names are familiar. Technology dominates the top. NVIDIA, Alphabet, Apple, Microsoft, Broadcom, Micron, healthcare and consumer names like Eli Lilly and Walmart show up too. These are companies with fortress balance sheets, low debt, and decades of accumulated profits. The formula rewards asset-light, high-margin businesses, which is why big tech clusters at the top of the safe zone. Safe zone alone isn't enough. A company can be safe from bankruptcy and still be a poor investment. Declining revenues, negative return on equity, cash hoarded unproductively. We want companies that are both safe and high quality. 4 new filters. Piotroski score of 5 or higher ensures the company's fundamentals are at least stable, not deteriorating. Positive return on equity confirms the business generates profits for shareholders. Debt to equity below 1.5 catches companies where market cap inflation might be propping up the Z-score, while book leverage is dangerous. Together with the Z-score, this creates a multi-angle check on financial health. Z-score asks, is this company safe? Piotroski asks, is this company getting better? Debt to equity asks, is leverage truly conservative? Return on equity asks, does the business actually make money? All 4 need to pass. The Z-score has real blind spots you need to understand before using it. The original weights were calibrated on 1960 manufacturing firms. Asset-light businesses like software companies score abnormally high because they have tiny total assets relative to revenue and market cap. The scores are directionally right, but the absolute numbers are inflated for modern service businesses. The formula is backward-looking. It uses the most recent annual filing. A company can move from safe to distress in 1 quarter if business collapses. Enron had a reasonable Z-score right up until it didn't, and it can't tell you about valuation. A company with a Z-score of 15 might be safe from bankruptcy, but trading at 60 times earnings. The Z-score is a safety filter, not a complete investment thesis. Pair it with valuation and quality metrics. The screen is live on CetaResearch.com. You can adjust the Z-score threshold, add or remove quality filters, and run it against any exchange. Link in the description. The full backtest is coming up next, where we tested the Z-score as a stock selector across 13 exchanges. That's where the results get genuinely surprising. The Z-score works brilliantly in some markets and completely fails in others. Subscribe to see the data.